Hello everyone, welcome back to Stock Market Meridian. Today is 13th August 2026 and you're watching today's post-market report. Today the Indian markets opened almost around yesterday's closing level and for most of the session we saw a sideways market. There was no clear dominance from either the bulls or the bears, and with Sensex weekly expiry we also saw some volatility during the day. By the end of the session, the Nifty closed in the negative zone while the Sensex managed to close in the positive zone. If we look at the sectoral performance, metals and private banking were among the top losers today, while chemicals and realty sectors were the top gainers. So overall, it was a relatively quiet session in terms of index movement, but there were quite a few important developments happening underneath the surface. Let's go through them one by one. Starting with gold and silver, we saw an interesting situation today. The latest US inflation data came broadly in line with expectations, which further strengthened expectations that the Federal Reserve could move towards a more accommodative policy. The July US Consumer Price Index came strictly in line with expectations, and this came after the weak non-farm payroll data, which showed a decline of around 23,000 jobs. Because of these developments, the probability of a September Federal Reserve rate hike has fallen to around 38%, compared with 48.4% earlier this week. So the market is now increasingly expecting the Federal Reserve to either keep rates unchanged or potentially move towards rate cuts. And we could see this reaction in international gold prices. US gold futures for December delivery climbed to around $4,509 per troy ounce, reaching a 2-month high following the CPI announcement. But in the domestic market, gold and silver didn't show the same kind of strength. The main reasons are the strong US dollar and elevated 10-year US Treasury yields. Now coming to the automobile sector, there is another concern developing here, and it is related to rising input costs. Indian automakers are currently facing higher prices across several important raw materials, including steel, rubber, copper, and semiconductors. The important thing here is that this isn't just a rise in the price of one particular commodity. Several important inputs are becoming more expensive at the same time. Steel alone accounts for around 40% of vehicle manufacturing costs, and steel prices have increased by as much as 24%, partly because of import safeguarding duties. Natural rubber prices have increased by around 53%, which is putting significant pressure on tire manufacturers such as SIAT. Copper prices have also risen by around 10%, partly because electric vehicles require more copper compared with conventional vehicles. And along with this, we are also seeing higher aluminium, semiconductor, freight, and energy costs. So naturally, this is creating pressure on the margins of automobile companies and their suppliers. Auto component manufacturer Sona Comstar has described the current environment as one of the most severe periods of margin pressure it has experienced, mainly because of raw material, freight, and energy inflation. And the timing is also important, because the festive season is approaching. This is one of the most important periods for automobile sales in India. So companies now have to decide how much of this additional cost they can absorb and how much they need to pass on to customers. Tata Motors CEO Girish Wagh said commodity inflation remains a major headwind for its commercial vehicle business in Q2, and further price hikes could become necessary if internal efficiencies aren't enough. M&M CFO Amarjyoti Barua also highlighted the difficult balance between protecting margins and maintaining sales volumes. M&M has already taken price hikes of around 1.5% to 2.7%. Maruti Suzuki increased prices by around 0.5% in June, followed by another hike effective from August. Honda Cars India also increased vehicle prices in August due to higher input and logistics costs. Meanwhile, Hyundai Motor India is trying to manage the pressure through calibrated pricing and internal cost reduction measures before deciding on further price increases. So, the automobile sector will be an important one to watch in the coming months. The key question is whether companies can protect their margins without affecting festive season demand. Now let's come to Reliance Industries. The stock came under pressure today after global index provider MSCI reduced Reliance's weightage in its India index as part of its August 2026 review. And this is important because changes in major global indices can lead to significant passive fund flows. In Reliance's case, the reduction is estimated to trigger around $523 million of passive outflows. Reliance shares fell around 1.5% to 2% during early trade and touched an intraday low of approximately Rs 1,329 per share. The index changes will take place on August 31 and become effective from September 1, 2026. Along with Reliance, several other Indian stocks are also expected to see outflows. Jio Financial Services could see around $61 million, Indian Hotels around $32 million, Aditya Birla Capital around $21 million, and Colgate-Palmolive around $16 million. But the MSCI review isn't only about outflows. Some Indian companies have also been added to the MSCI Standard Index, which could bring fresh fresh passive inflows. Laurus Labs, Lenskart, Adani Energy Solutions, and Grow have been added. The estimated inflows are around $598 million for Laurus Labs, $352 million for Lenskart, $310 million for Adani Energy Solutions, and $256 million for Grow. Eternal leads the overall weight increase inflows at around $674 million, followed by Adani Enterprises at around $202 million. On the other side, Balkrishna Industries, SBI Cards, and Astral were removed from the standard index. Interestingly, India's overall weight in the MSCI standard index has increased from 11.8% to 11.9%, while the number of Indian constituents has increased to 166 companies. So this entire MSCI reshuffle could create meaningful buying and selling flows across several Indian stocks. Moving on to the sugar sector, this was one of the stronger pockets of the market today. Several sugar stocks rallied sharply, with some companies gaining as much as 7%. The main reason is the sharp increase in domestic sugar prices. Indian sugar prices have increased around 8% to 10% over the past month, reaching a 7-year high. Prices are now around $4,400 to $4,800 per quintal, and naturally, higher realizations are positive for sugar producers. We saw Dalmia Bharat Sugar gain around 7%, while Uttam Sugar rose around 6%. Dhampur Sugar Mills gained around 4%, and Balrampur Chini Mills increased around 3%. The international market is also supporting this move. US raw sugar futures crossed resistance and moved to around $16 per pound. London white sugar also reached a 15-month high of more than $500 per ton. The major concern in the global market is supply. Weather risks, production cuts, and increasing diversion of sugarcane towards ethanol are tightening the supply situation. Brazil, the world's largest sugar producer, has warned about harvest delays because of adverse weather. In June, Brazil diverted around 58% of cane juice towards ethanol while increasing its blending target to 32%. Thailand has also reduced its projected output by around 15.6% to approximately 9.5 million tons. European production is also facing pressure because of intense heat waves. For India, the export outlook is becoming tighter as well. India could have minimal export surplus for up to 3 seasons, partly because of El Niño impacts and rising domestic ethanol blending demand. Major trade houses are currently projecting a global sugar deficit between 0.26 million and 3.3 million tons for the current season. So the combination of higher prices and tightening global supply is currently supporting the sugar sector. Now, let's look at something particularly interesting in the banking sector. The long-standing competition between HDFC Bank and ICICI Bank has reached an important point. The market cap gap between these two private sector banking giants has now narrowed to around 9% to 10%. HDFC Bank's market capitalization is currently around 11.2 lakh crore, while ICICI Bank has crossed approximately 10.2 lakh crore. But if we look back a decade, the difference was enormous. HDFC Bank once had a 107% valuation lead over ICICI Bank, and even as recently as late 2025, the gap was around 58%. But ICICI Bank has significantly closed that gap during 2026. Over the past decade, ICICI Bank's market capitalization has increased nearly 6 times, while HDFC Bank's valuation has grown around 2 times. Several factors are responsible for this change. At HDFC Bank, corporate governance developments, margin compression following the merger, and foreign institutional selling have affected investor sentiment. Boardroom changes that began in mid-March 2026, along with leadership uncertainty, have also weighed on the stock. HDFC Bank has fallen more than 26% year-to-date. The integration of HDFC Limited's mortgage portfolio brought in lower-yielding housing loans, keeping HDFC Bank's NIM below 4%. ICICI Bank, meanwhile, has consistently maintained NIMs above 4%, strong asset quality, and a healthy return on assets of around 2% to 2.3%. Foreign institutional ownership in HDFC Bank has also declined for 5 consecutive quarters, reaching around 41.82% in Q1 FY27. However, there is one important point to remember. Even though the market cap gap has narrowed significantly, HDFC Bank is still much larger in terms of its loan book. HDFC Bank's loan book stands at around 30.61 lakh crore rupees, compared with around 16.31 lakh crore rupees for ICICI Bank. So while ICICI Bank has rapidly caught up in terms of valuation, HDFC Bank continues to maintain a significant lead in terms of business size. Now let's quickly look at today's major corporate results. Starting with Godrej Industries. Revenue improved on a year-on-year basis, while EBITDA margins improved on a quarter-on-quarter basis. But apart from that, most of the other major performance parameters declined strongly. So overall, the results were disappointing. Next is is Max Healthcare. The company delivered a mixed set of numbers. Revenue improved, but margins declined. EBITDA and net profit improved on a year-on-year basis, but both declined on a quarter-on-quarter basis. Overall, the results were weak. Moving to Jubilant FoodWorks. Revenue and EBITDA improved, but net profit and margins declined on a year-on-year basis. So overall, another weak set of results. Now coming to Solar Industries. This was clearly one of the positive results of the day. The market was already expecting strong numbers from the sector, but Solar Industries managed to beat those expectations. Almost all major earnings parameters improved strongly. So overall, Solar Industries delivered a very strong performance. And finally, Aditya Birla Real Estate. Revenue improved on both year-on-year and quarter-on-quarter basis. EBITDA and net profit improved only on a quarter-on-quarter basis, while margins continued to show some weakness. Overall, the results were disappointing. So if we put everything together, today's market wasn't really about a big move in the Nifty or Sensex. Instead, it was about several individual themes developing across different parts of the market. US inflation data is changing expectations around the Federal Reserve. Automobile companies are dealing with rising input costs just as the festive season approaches. MSCI changes are creating potential fund flows in and out of Indian stocks. Sugar prices are supporting sugar companies, and the valuation gap between HDFC Bank and ICICI Bank continues to become smaller. At the same time, the potential delivery block deal and today's corporate earnings are giving investors more stock-specific developments to watch. So even though the indices moved sideways today, there was plenty happening underneath the surface. And this is something we should always remember in the stock market. The market doesn't always give us a big move every day. Sometimes the most important developments are happening quietly in sectors, in individual stocks, and in global market flows. That's why it's important not to focus only on whether the Nifty closed green or red. Instead, we need to understand what is actually driving the market beneath those numbers. And that is what we'll continue to track here at Stock Market Meridian. And that's all for today's post-market report. If you found this analysis useful, make sure to like this video, share it with your fellow investors, and subscribe to Stock Market Meridian. I'll be back tomorrow morning with another detailed pre-market report covering the global markets, important developments, commodities, and the key factors that could influence the Indian market before the opening bell. Until then, trade carefully, stay informed, and most importantly, never let the market control your emotions. The market will always give us another opportunity. So protect your capital, stay disciplined, and focus on the bigger picture. Thank you so much for watching. This is Stock Market Meridian signing off. Jai Hind.